We would like to welcome you to the Stefanutti Stocks Financial Results webcast for the 12 months ended 28 February 2022. I would like to take this opportunity to congratulate Yolanda du Plessis on her appointment as Chief Financial Officer effective 20 May 2022. Well done and congratulations, Yolanda.
Thank you, Russell.
Antonio Cosciante will continue focusing on the implementation of the restructuring plan. The presentation will be available on our website. We have changed the structure of our presentation. I will be presenting the environmental, social and governance, update of the restructuring plan and operational overview. Yolanda will then take us through the financials. I will then discuss industry-related matters and close by discussing our strategic objectives for the new financial year. There is time at the end of the presentation for a question and answer session. This project is the 100-bed Swazimed referral hospital, which the group recently completed in Eswatini. For the first time, we will be covering all pillars of the environmental, social and governance. Our ESG strategy allows the group to manage the risk associated with ESG services using effective ESG practices. Our people are the group's enablers. They are our real assets. The last few years have been difficult for the group, resulting in a reduction in funds available to train and develop our people. The group currently employs 5,611 permanent employees. The following investments were made in our people: 8 million on skills development training, 2.5 million on 18 scholarships, 3.2 million on 50 bursaries, and 1.3 million on health and safety training. Stefanutti Stocks has its own academy registered with the Mining Qualification Authority, allowing it to train and qualify operators and drivers. The academy has memorandums of understanding with CETA and Mercita, allowing the group to provide all construction-related training and apprenticeship in-house training. Our governance relies on the 3 lines of defense model applied throughout the group. The board, exco and senior management being responsible for corporate governance, risk management and internal control as the first line of defense. Line management responsible for the second line of defense, and our external accreditation service providers, internal audit and external audit being the third line of defense. Various other external assurance providers assist on an ad hoc basis. All assurance providers, whether internal or external, provide the necessary comfort via various reviews and reports to both exco and the board regarding the adequacy and effectiveness of corporate governance, risk management and internal control processes. The group endorses and supports the 4 governance outcomes set out by the King 4 report, which are ethical culture, good performance, effective control, and legitimacy. The application of the King 4 principles is assessed and reviewed on an ongoing basis. The following ISO standards are implemented and currently operating throughout the group: Quality Management System, Environmental Management System, Health and Safety Management System, and Information Security Management System in the implementation phase. Legal and statutory requirements are identified, placed on a register, and addressed by the relevant internal party. The group prides itself on its health and safety performance. There was no fatalities during the financial year. The group's lost time injury frequency rate and recordable case rate at February 2022 was 0.03 and 0.28 respectively. All the regions have performed well, with the group achieving 51.7 million hours without a lost time injury. The group carries an ISO 45001-2018 accreditation. As you can see from the graph, higher rates of COVID-19 infections were experienced in the financial year of 2022 due to the fact that there were no hard lockdowns. This higher infection rate disrupted operations due to infected employees and contacts having to leave the site and self-isolate. We have been unable to quantify the cost of such a disruption. Operations were also hampered throughout the year by clients and professional teams insisting on working remotely, making communications and decision-making difficult. The group continues to implement all necessary COVID-19 policies and protocols across all regions. Employees and subcontractors are being encouraged to vaccinate, with constant vaccine awareness campaigns being run throughout the group. Our environmental policies and plans are drafted to assist operations in not deviating from the client's environmental management plan. No significant environmental incidents or legal summonses were received for transgressions during the year. Environmental Deviation Frequency Rate, EDFR. In the absence of an industry standard, the group established its own measure and monitoring tool via the group's own software platform. The EDFR is closely based on the LTIFR, measuring all incidents and non-conformances. The group carries an ISO 14001-2015 accreditation. Driving quality in the group increases efficiency, increases productivity, decreases wastage, ensures consistent outcomes, increases profit, provide an improved customer experience, resulting in customer retention and acquisition. Customers on our projects are regularly requested to complete our customer satisfaction surveys, where our operations are rated against program and time, cost, quality, safety, health and environment, general and culture. The group has set an internal minimum benchmark of 80%. Where this is not achieved on any pillars, senior management engages with the client. Over the last 4 years, client feedback has been consistent, as reflected by the graph. The group carries an ISO 9001-2015 accreditation. The group is a Level 1 broad-based Black economic empowerment contributor, measured against the criteria of the construction sector charter, with the following scores: Black ownership, 64.28%, management control, 60.38%, employment equity, 70.97%, skills development, 119.03%, preferential procurement, 106.84%, enterprise development, 100%, with 10 companies active on our program. Socioeconomic development, 120%. Corporate social investment spend in excess of 1 million rand. The group has 2 VLP partners, namely Access and Grinica LTA. The construction sector is one of the least digitized industries in South Africa and globally. While it is largely attributed to the complexity of the industry, the power of data can no longer be ignored. It is at the heart of everything, and if properly harnessed, can fundamentally increase productivity in the group. The group has a digitized core business process with the right software, providing real-time dashboards to help make quick and informed decisions. The group's own software platform captures and measures all ESG metrics. We have a number of sites using building information modeling, commonly known as BIM, with more coming on board as new sites start, ultimately harnessing full 5D. We are testing wearables to assist with progress, costing, tracking, unsafe behavior, all to enhance productivity. We are already using tags and sensors for sharing information, inventory management, time and attendance, and equipment tracking. Drone surveillance is used for measuring and recording progress. All document and record management is paperless archiving. This is an aerial view of the International Convention Center and 5-star International Hotel that the group constructed in Eswatini. In accordance with the restructuring plan, the lenders have provided the group with total funding of 1.205 billion. Following the receipt of the initial purchase consideration of 92 million for the disposal of Altair Stocks LLC, a capital repayment of 45 million was made on 15 November 2021. The group, on 21 February 2022, reached an agreement with the lenders to extend the current capital repayment profile of the loan, as well as its duration, to 28 February 2023. Due to the slower than anticipated sale of certain operations, the non-implementation of the materials handling and tailing management subdivision transaction, and further delays in resolving contractual claims and compensation events on certain projects resulted in capital repayments envisaged to commence from April 2022 not materializing. The group is currently in negotiations with the lenders to extend the capital repayments of the loan to January and February 2023, with the residual loan balance remaining at approximately 420 million. Interest on the loan is serviced on a monthly basis. The group continues to evaluate an optimal business model and associated capital structure. The sale of non-core assets, industrial and residential properties to the value of 56.2 million have been sold during the year. An industrial commercial fabrication workshop in Isando for 33 million is in the process of being sold. Sale of certain operations. Mining Services Division. As announced on the 23rd of August 2021, shareholders were advised that not all conditions precedent relating to the sale of the materials handling and tailings management subdivisions had been fulfilled or waived, and consequently the disposal could not be implemented. These disciplines have been retained and therefore reclassified as part of continuing operations. During the protracted sale process, the order books of these disciplines were severely eroded due to extensions on existing contracts not being granted and current clients excluding these disciplines on tender invitations and the resignation of key staff. We are currently refocusing and rebuilding these disciplines, including the re-employment of the senior management team that had previously resigned. Good progress has already been made in operations with an improvement in the order book. United Arab Emirates operation. The transaction relating to the disposal of 49% of the entire issued share capital of Altai Stocks was approved by shareholders on 31 August 2021. Condition precedents relating to this transaction are being progressed. In accordance with the terms of the transaction, the group received the initial purchase consideration of 92 million on 8 November 2021, as set out in the circular issued to shareholders on 3 August 2021. The balance of the purchase consideration, being the equity value adjustment and retention amount, is based on Altai Stocks' ability to successfully settle outstanding claims and final accounts on certain projects. As at the end of April 2022, the sale of underutilized plant and equipment, including plant that has reached end of useful life, a total of 171 units with a sales value of 68 million and a net book value of 40 million had been sold. There remains 97 units to be sold. Winding down of contract mining subdivision. During the comprehensive sale process, no offers were received for contract mining subdivision. As a result, the subdivision has been wound down, with the last project completed in October 2021. Contract mining plant is in the process of being sold. To date, a total of 142 units with a sales value of 226 million and a net book value of 185 million had been sold. A total of 42 million of outstanding installment sales relating to all contract mining plant and equipment was settled. There remain 19 units to be sold. At the year end, the marine operation had completed all its projects. As a result, 54 units of plant will become available for sale. With respect to the outstanding amounts due by the Zambian government, 18 million rand has been collected since the beginning of the financial year. The timing and quantum of receipts remains irregular. We anticipate collecting a further 48 million at current exchange rates. With respect to a contract mining debtor who defaulted on their payment terms, for which 30 million was provided for in August 2019, the group had debtors insurance on this contract. The insurer initially repudiated our claim. During arbitration proceedings, the parties agreed an interim settlement of 9 million. A repayment plan has been entered into with the mine owner to recover a further 12 million over the next 3 financial years. However, the mine has now been placed into provisional liquidation. SSBR joint venture package 16 update. All construction work is complete, inclusive of snagging. A small team will remain on site until the end of this month attending to defects. SSBR is busy demobilizing and will be off-site by the end of the month. A small team of clerical staff will remain on-site until the end of June for the purpose of closing out documentation. Update on measurement. The sectional final measurements have been concluded. Still to be agreed are contractors' information requests, new rates, engineers' instructions and variation orders. Should the parties be unable to resolve these issues, they will be referred to the Dispute Adjudication Board for a decision. Eskom continues with the adverse approach to certification. However, SSBR has been able to motivate certification in the amount of 71 million for the year, all of which has been paid. Update on the agreement. As previously mentioned, SSBR and Eskom have both committed to a claims resolution process for all causes and delays to the end of December 2019, which involves the appointment of independent experts to evaluate the causes of delays and the quantification thereof. The parties and the DAB have signed a further joint agreement which states that the DAB will issue decisions confirming the entitlements which the experts have agreed, which will be binding on the parties. The DAB will rely on the experts for the narrowing of issues and information must consider. The DAB will continue to make interim decisions on the narrowed issues and information in a progressive manner, which will be binding on the parties. The DAB will issue such interim decisions for both time and money. At the end of the process, in respect of both time and money, the DAB will issue a final decision in terms of the contract, at which point, and not prior thereto, a party may issue a notice of dissatisfaction and refer the dispute to arbitration, if at all. Update on delay. The contract comprises 77 sections, and both parties' independent delay experts have completed all analysis and submitted their final differences to the DAB for a decision on delay entitlements. Meetings led by the DAB started during November 2021. Phase 1, access-related disputes. The parties' delay experts have reached agreement. Phase 2, construction-related disputes. 7 key sections, which contain the majority of differences between the parties' delay experts, were referred to the DAB. Interim decisions on all of the sections covering most of the differences have been received. It is anticipated that the 7 key sections will cover the majority of the construction-related disputes between the parties. Phase 3, commissioning-related delays. The DAB will shortly be engaged to issue interim decisions on the differences between the parties' delay experts. The interim decisions on the 7 sections and the commissioning will allow the parties' delay experts to calculate the final entitlement, subject to minor outstanding issues, and compile a joint final delay expert report. This will be followed by the quantum experts who will calculate the financial entitlements based on the joint financial delay expert report. Update on quantum. The independent quantum experts have completed their exercise of interrogating the total costs which have been incurred on the project. The interrogation was conducted on a sampling basis, and to date no anomalies have been found. The quantum experts have agreed the methodology to apply the project costs to the delay entitlements to quantify the financial consequences of the delay. Although differences of principle are anticipated, the quantum experts are engaging on these principles and attempting to narrow the issues that would then be referred to the DAB for interim decisions. This process is being run in parallel with the delay process. Other claims post-December 2019. SSBR was successful with its COVID-19 claim on both merits and quantum. The DAB awarded an extension of time of 57 days and quantum of 26.1 million. After December 2019, a further 85 claims have been submitted to the engineer, to which the engineer has only responded to 35. SSBR is requesting the engineer to provide his determination on all claims submitted in order to proceed to refer the rejection of the claims to the DAB. Following the successful dispute of the COVID-19 claim award, the engineer has acknowledged that his interpretation of the contract may be incorrect and therefore needs to reassess all submitted claims. All disputed claims will be referred to the DAB. Claims recognition. These claims have not been recognized in the financial statements. Stefanutti Stocks Izazi Joint Venture Package 28 update. During June 2018, the JV commenced adjudication proceedings in relation to numerous compensation events which had not been assessed. During February 2019, this contract was terminated due to Eskom's inability to provide access to the JV to complete the works. The engineer issued 2 negative final payment certificates in August 2019 and April 2020 respectively, alleging overpayments had been made to the JV. This prompted the notification of many new disputes, which were then included in the adjudication process. Adjudication hearings were conducted during November 2020 and February 2021. As several disputes related to measurement of the works, the JV and Eskom have embarked on an independent expert process to resolve these disputes. In order to accommodate this independent expert process, the adjudicator has been requested not to publish his decision. The measurement of direct work should be concluded by the end of May. Thereafter, it is our intention to request the adjudicator to release his decision, whereafter we hope to engage with Eskom on the remaining compensation events. If this can be resolved amicably, we should be able to have a final account agreed by the end of July 2022. Given the magnitude of the amounts in dispute, it is highly probable that the disputes will be referred to arbitration, which could delay this matter further. This project is the headgear substructure for Ivanplatz, which is currently under construction. We have just been awarded the contract to construct the remainder of the headgear. Year-end review. An improved performance was delivered for continuing operations on a normalized basis in what remains a difficult environment in all regions. The group's results continue to be affected by COVID-19, as mentioned in the COVID slide. The award and adjudication of tenders, especially in the public sector, where it can take up to 2 years to have a contract award, had a significant impact on holding costs through all regions and disciplines in the group. Abnormal legal fees to close out legacy issues negatively affected results. The group is on track to wrap up all these matters by February 2023. There was an increase in tender activity during the second half of the year. The focus of the group is to reduce the number of loss-making projects and return the group to profitability. For the financial year, of the 142 active projects, 21 projects declared an aggregated operating loss of 62 million against an aggregated contract revenue of 383 million. Having said this, 70% of reported contract revenue was executed at better than tender margin, compared against 59% at August 2021. We will continue with our drive to achieve a minimum of tender margin on all projects. In line with the restructuring plan, the group has initiated a disposal program to sell certain operations which have accordingly been classified as discontinued operations. Consequently, the results for this period and the comparative period have been prepared to reflect continuing and discontinued operations. I shall now cover the key indicators for continuing operations. There has been an increase in contract revenue to 6 billion when compared against restated February 2021 of 4.7 billion. The group is reporting an operating loss of 99 million when compared against a restated operating loss of 55 million in February 2021. The group's order book at March 2022 is 5.3 billion. The other financial indicators will be covered by Yolanda later in the presentation. Management and staff remain committed to our health, safety and environmental policies and procedures, and together strive to constantly improve the group's health, safety and environmental performance. I would like to explain what a normalized operating profit would be for the group for this period. Included in the results are the following abnormal and non-operational items. Restructuring costs of 95 million. Abnormal legal fees of 20 million. Fair value adjustments and impairment of assets relating to properties of 36 million and plant of equipment of 12 million. Goodwill impairment of 106 million relating to the stocks acquisition and mining services discipline, and a provision of 28 million relating to the City of Cape Town settlement. By excluding these amounts, normalized trading would have been an operating profit of 198 million at a 3.3% operating margin. Although current liabilities has exceeded current assets over the past 4 reporting periods, the group has been able to successfully execute 28 billion rands worth of work. Thanks to the support of the lenders, our operations are not hampered by working capital constraints. The lenders continue to provide guarantee support for current and future projects being undertaken by the group. Management has made considerable progress in reconfiguring the group's organizational structure to improve operational performance and decrease overhead costs, including the reduction of the group's overall headcount. This is an ongoing process which continues as the various aspects of the restructuring plan are being implemented. Stefanutti stocks will continue to update shareholders on the progress of the various aspects of the restructuring plan. Effective from 1st March 2021, the group has reorganized its operations into regions, with the exception of the mechanical and electrical business, which has been renamed Mechanical Electrical Piping, MEP, comprising the following disciplines: mechanical, electrical and instrumentation, oil and gas. The inland region comprises the following disciplines: roads and earthworks, civils, geotechnical, building, material handling, and tailings management. The coastal region comprises the following disciplines: roads and earthworks, civils, and building. The Western Cape region comprises the following disciplines: civils and building. The Africa region offers multidisciplinary expertise in Botswana, Eswatini, Malawi, Zambia, and Zimbabwe. I shall now discuss the performance of the regions. This was a multidisciplinary project executed by the civils and geotechnical disciplines of the inland region, being precast composite storage bunkers for Sasol Mining in Mpumalanga. The inland region's contract revenue is 2 billion compared to 1.7 billion as restated for February 2021, with a normalized operating profit of 118 million compared against an operating profit of 34 million in February 2021. These results also include the following abnormal costs: legal fees of 11 million, retrenchment costs of 6.4 million, and holding costs of 13.9 million. The contract mining subdivision was wound down in October 2021 and is disclosed as part of discontinued operations. The non-implementation of materials handling and tailings management subdivision transaction, as mentioned previously, negatively impacted the results. The following disciplines performed to expectation: roads and earthworks and civils. The former Gauteng building division, now forming part of the inland region, has been right-sized and refocused due to its declining order book. 68% of this region's contract revenue was executed at better than tender margin. As previously reported with respect to 2 contract mining project terminations, one project has been amicably settled with a client and the other is proceeding to arbitration. The group is confident that the termination was lawful and therefore no provision has been made. The arbitration is expected to be completed by February 2023. Percentage turnover and order book by sector. The blue indicates contract revenue for the year, with the grey indicating the current order book within the various sectors. 64% of reported contract revenue was in surface mining related services, bulk earthworks, and building other. In the current order book, 82% is in surface mining related services, bulk earthworks, geotechnical, and water sanitation and pipelines. The order book at March 2022 was 2 billion. Opportunities exist for this region in transport infrastructure, water and wastewater treatment plants, mine infrastructure, renewable energy, and geotechnical sectors. In the short term, there are potential awards to the value of approximately 1.5 billion, and for the future, projects to the value of approximately 30.1 billion have been identified. This is a project that the group just completed for Transnet at Island View in Durban. Our oil and gas discipline constructed the 2 identical tanks, 36 meters in diameter with a height of 23 meters. Coastal civils discipline constructed the aprons and all ancillary civil works. The coastal region's contract revenue is 1 billion compared to the 935 million as restated for February 2021, with a normalized operating profit of 3 million compared against an operating loss of 7 million in February 2021. These results also include the following abnormal costs: retrenchment costs of 2 million, and holding costs of 14.7 million. The region's profitability was negatively impacted by the July 2021 civil unrest. 53% of this region's contract revenue was executed at better than tender margin. Percentage turnover and order book by sector. 74% of the reported contract revenue was in building other and water, sanitation and pipelines. In the current order book, 97% is in water, sanitation, pipelines, bulk earthworks and building other. The order book at March 2022 was 991 million. Opportunities exist for this region in transport infrastructure, water and wastewater treatment plants, and in the private sector, commercial, retail and industrial projects. In the short term, there are potential awards to the value of approximately 1.4 billion, and for the future, projects to the value of approximately 19.3 billion have been identified. The building discipline within the Western Cape region has just completed a mixed-use development within the Newlands Cricket Ground. The Western Cape region's contract revenue is 1.1 billion compared to the 535 million as restated for February 2021, with a normalized operating profit of 55 million compared against an operating profit of 5 million in February 2021. These results also include holding costs of 2.1 million. The building discipline performed in line with budget. 91% of this region's contract revenue was executed at better than tender margin. Percentage turnover and order book by sector. 57% of the reported contract revenue was in building, factories and warehouses. In the current order book, 95% is building other and water, sanitation and pipelines. The order book at March 2022 was 640 million. Opportunities exist for this region in water and wastewater treatment plants, framework agreements, and in the private sector, commercial, residential, retail, industrial plants, warehouses and data centers. In the short term, there are potential awards to the value of approximately 900 million, and for the future, projects to the value of approximately 13.7 billion have been identified. The Mozambique region constructed a new brewery for AB InBev on the outskirts of Maputo. The Africa region's contract revenue is 1.6 billion compared to the 1.2 billion as restated for February 2021, with a normalized operating profit of 102 million compared against an operating profit of 73 million in February 2021. These results also include abnormal legal fees of 2 million. The following disciplines performed in line with budget: Botswana, Eswatini and Zambia. 70% of this region's contract revenue was executed at better than tender margin. Percentage turnover and order book by sector. 99% of the reported contract revenue was in transport infrastructure, building, office and commercial, and water, sanitation and pipelines. In the current order book, 87% is in transport infrastructure and building, office and commercial. The order book for March 2022 was 970 million. Opportunities exist for this region in transport infrastructure, water and wastewater treatment plants, pipelines, dams, strategic fuel farms, and in the private sector, commercial, retail, office, leisure, warehouses, mine infrastructure, renewable energy, and industrial projects. In the short term, there are potential awards to the value of approximately 1.1 billion, and for the future, projects to the value of approximately 15.8 billion have been identified. This project was to rebuild the flotation plant at Voskhor that had been damaged by a fire. This was a multidisciplinary contract involving mechanical discipline and civils discipline within the inland region. Mechanical electrical piping's contract revenue is 307 million compared to the 270 million as restated for February 2021, with a normalized operating loss of 63 million, the same loss as in February 2021. These results also include the following abnormal costs: retrenchment costs of 1 million and holding costs of 10.1 million. This business has been severely impacted by the effects of COVID-19 pandemic has had on global commodity prices, resulting in major plant maintenance and upgrade projects being put on hold. Due to the ongoing shortage of available work in all disciplines, all cost-saving opportunities have been taken, including optimum right-sizing. 73% of this region's contract revenue was executed at better than tender margin. With respect to the oil and gas disciplines arbitration matter relating to the cancellation of a petrochemical contract, which had to be postponed due to a fundamental change in the client's defense, a date for the arbitration is yet to be set. At this stage, the financial impact thereof cannot be quantified. With respect to the mechanical disciplines project termination, the arbitration process is expected to be completed by February 2023. The group is confident that the termination was lawful and therefore no provision has been made. Percentage turnover and order book by sector. 86% of the reported contract revenue was in industrial plants, oil and gas. In the current order book, 88% is in surface mining related services. The order book at March 2022 was 711 million. Opportunities exist for this business in renewable energy, industrial projects, clean fuels, tank farms, data centers, mining infrastructure, plant upgrades, shutdowns, and maintenance. In the short term, there are potential awards to the value of approximately 777 million, and for the future, projects to the value of approximately 6.3 billion have been identified. This slide is a consolidation of the group's contract revenue and March 2022 order book by sector. 15% of contract revenue in South Africa comes from the public sector, consisting of water, sanitation and pipelines and transport infrastructure. 17% of contract revenue outside South Africa is in the public sectors of Botswana and Eswatini. 33% of the current order book of 5.3 billion is from outside of South Africa. In the short term, there are potential awards to the value of approximately 5.6 billion, and for the next 12 months, projects to the value of approximately 85.2 billion have been identified. The historical order book reflects the order book for total operations and continuing operations for the financial years ended February 2019 to February 2022. The significant difference between the total operation and continuing operations order book is predominantly due to the winding down of contract mining subdivision, the sale of the United Arab Emirates operation, and the foreign operation held for sale. I shall now give some guidance for the next financial year for continuing operations on a normalized basis. Inland region, we expect contract revenue to remain consistent with a reduced operating profit margin to a more normalized level. Coastal region, we expect a significant increase in contract revenue with an improved operating profit. Western Cape region, we expect contract revenue to remain consistent with a reduced operating profit margin typical of a building operation. Africa region, we expect a slight reduction in contract revenue and a slightly reduced operating profit margin. Mechanical electrical piping, we expect contract revenue to double with an operating profit margin similar to the normalized margin as reported by the group in 2022. Included within head office are the abnormal restructuring costs comprising advisory, legal and funding fees relating to the restructuring plan. We expect similar costs as currently reported. I would now like to hand you over to Yolanda for the financial overview.
Thank you, Russell. These results are in line with the trading update released on SENS on 18 May 2022, indicating earnings per share and headline earnings per share for continuing operations to reflect a loss of between 150 cents and 180 cents per share and a loss of between 60 cents and 90 cents per share, respectively. In line with the restructuring plan, the group has initiated a disposal program to sell certain operations which have accordingly been classified as discontinued operations. These disposals are expected to be concluded within the next 12 months. Consequently, the results for this period and the comparative period have been prepared to reflect continuing and discontinued operations in accordance with international financial reporting standards. Some financial indicators relating to continuing operations. Contract revenue, 6 billion. Operating loss of 99 million. Headline loss per share of 78 cents and headline loss per share of 97 cents for total operations. On the 21st of February 2022, the group reached an agreement with the lenders to extend the loan duration on standard terms and conditions applicable to this type of funding to 28 February 2023. The group is currently in negotiations with the lenders to extend the capital repayments of the loan to January and February 2023, with the residual loan balance remaining at approximately 420 million. Lenders have agreed to provide continued guarantee support for current and future projects being undertaken by the group. The purpose of the restructuring plan is to put in place an optimal capital structure and access to liquidity to position the group for long-term growth. Implementation of the restructuring plan to be concluded by February 2023. To the extent required, shareholder approval will be sought for various aspects of the restructuring plan. Cost of funding is 5.4% above prime, including arranging and facility fees. The funding provided by the lenders has assisted in relieving the group's liquidity pressures, even though total liabilities exceed total assets at 28 February 2022, representing technical insolvency. However, the group remains commercially solvent based on the cash flow projections included in the restructuring plan and the continued support provided by the lenders. In addition thereto, uncertainties surrounding the contingent liabilities, as noted in Note 26 of the group's consolidated annual financial statements for the year ended 28 February 2021, continue to indicate that a material uncertainty exists that may cause doubt on the group's ability to continue as a going concern in the short term. The directors consider it appropriate that the group's results for the year be prepared on the going concern basis, taking into consideration the current order book, imminent project awards, continuing operations executing the group's order book profitably, the availability of short and mid-term projects, reaching a favorable outcome on contractual claims and compensation events on certain projects, having converted the short-term funding agreement with the lenders to a loan terminating on 28 February 2023, the assumption of a successful completion of current negotiations with the lenders relating to the extension of capital repayments of the loan to January and February 2023, continued support from the lenders, and successfully implementing the restructuring plan. Moving on to the statement of profit or loss. With respect to continuing operations, contract revenue for the Inland, Western Cape and Africa regions increased by 237, 531 and 392 million respectively, resulting in an overall increase in contract revenue from 4.7 billion to 6 billion. EBITDA improved due to the profitability of the Inland, Western Cape and Africa regions. EBITDA includes a settlement with the City of Cape Town relating to the civil claim. A liability of 28 million was raised at year-end. Due to the underutilized plant and equipment being sold in terms of the restructuring plan, the depreciation charge has reduced to 54 million, which includes an IFRS 16 right-of-use charge of 8 million. The following costs are included within operating loss. Restructuring costs and abnormal legal fees of 115 million, Feb 2021 126 million. Fair value adjustment of 15 million relating to a property held for sale, Feb 2021 8 million. In line with group policy, land and buildings are independently valued every 5 years. Based on these valuations, certain properties have decreased in value, resulting in an impairment of 21 million. Fair value of adjustment of 12 million relating to plant and equipment held for sale, Feb 2021 2 million. The group is required to test goodwill for impairment at each reporting period or when there is an indicator of impairment. Based on tests performed, goodwill relating to the Stocks Limited acquisition and mining services discipline of 84 million and 22 million respectively has been impaired. Feb 2021, 26 million. The operating loss for continuing operations is 99 million. Should the restructuring costs, fair value adjustments and impairments and the settlement with the City of Cape Town be excluded, the operating profit would have been 198 million. Feb 2021, 107 million. Interest earned for the period is 19 million and interest paid decreased to 113 million. reduction in interest paid due to settlement of installment sales and a capital repayment on the loan of 45 million in November 2021. The tax charge has been impacted by the profitability of the cross-border operations, as well as the group not providing deferred tax on the losses incurred pertaining to the South African trading entity. Loss for the year from continuing operations is 264 million. The discontinued operations reported a loss of 151 million, predominantly comprising a fair value adjustment of 76 million relating to Altair stocks and 62 million to the foreign operation held for sale. Subsequent to year-end, a non-binding offer of $13.5 million was received for this foreign operation. Negotiations are ongoing and no terms have been agreed as yet. Loss for the year for total operations amounted to 415 million. Headline earnings per share for continuing operations is a loss of 78.28 cents per share, and headline earnings per share for total operations is a loss of 97.07 cents per share. Moving on to the statement of financial position. The reduction in property, plant and equipment is due to the impairment of properties, the reclassification to non-current assets held for sale and depreciation. CapEx spent for the year, excluding IFRS 16 right-of-use assets, is 18 million, of which 17 million relates to maintaining operations. Work in progress increased by 128 million to 738 million due to the late certification on one project shortly after year-end. There has been a 14% decrease in trade accounts receivable, despite an increase in trading activity, resulting in a decrease in debtors days from 95 days to 58 days. Non-current assets held for sale and disposal groups relate to discontinued operations and amount to 701 million. Goodwill reduced to an impairment recognized of 84 million relating to the Stocks Limited acquisition and 22 million relating to the mining services discipline. These impairments were triggered by the right-sizing and refocusing of the former Gauteng building division due to a declining order book, and the non-implementation of the sale transaction relating to the materials handling and tailings management disciplines, negatively impacting on these operations' order book. Moving to the liability side of the statement of financial position. Total interest-bearing liabilities have decreased slightly from 1.55 billion at February 2021 to 1.45 billion. As previously mentioned, the group is currently in negotiations with the lenders to extend the capital repayments of the loan to January and February 2023. A capital repayment of 45 million was made on 15 November 2021. Trade payables, accruals and other current liabilities have increased from 1.3 billion to 1.5 billion due to the increase in trading activity. Excess billings over work done has in total decreased by 343 million to 909 million. There has been a slight increase in total provisions from 592 million at Feb 2021 to 598 million. Liabilities associated with discontinued operations amount to 178 million. Moving on to the statement of cash flows. The cash flow statement is presented for total operations. Cash consumed from operations is 12 million as a result of the restructuring costs and abnormal legal fees incurred during the year. Working capital consumed 241 million, predominantly due to the repayment of excess billings over work done. Other investing activities predominantly comprises the sale of plant and equipment of 176 million. Financing activities reflects a reduction in total debt of 174 million, resulting in a decrease in cash from February 2021 of 347 million to 409 million, excluding cash of discontinued operations amounting to 24 million. In conclusion from my side, successfully implementing the restructuring plan and focusing on reaching a favorable outcome on contractual claims and compensation events on certain projects remain the top priority. I will now hand back to Russell to close the presentation.
Thank you, Yolanda. This development, consisting of a Stay Easy Hotel and Biomall, was constructed by the Mozambican region in Maputo. We will now cover industry-related matters. With respect to the civil claim received from the City of Cape Town for Greenpoint Stadium, the parties to the civil claim being the City of Cape Town, Wilson Bailey Homes, Avenge and Stefanutti Stocks, the contractors, remain confident of their respective legal positions. However, the parties have mutually agreed that it is in the best interest of all to amicably settle the matter rather than prolonged and extended and costly arbitration and court process. This will allow for future positive engagement between the City of Cape Town and the contractors. The settlement includes an annual payment of 10.5 million by each contractor over the next 3 years, a commitment to corporate social investment projects in the City of Cape Town district by Wilson Bailey Homes and Stefanutti Stocks. With respect to the voluntary rebuild program and our request for deferment of the 2020 contribution, a positive response was received, and it is anticipated that this contribution will be deferred to 2028. The group continues to be negatively affected through disruptive and unlawful activities by certain communities and informal business forums in certain parts of South Africa. The Botswana region has just completed an upgrade on the terminal buildings at Maun International Airport. In conclusion, our focus is on the successful implementation of the restructuring plan, achieving favorable outcomes by February 2023 from the processes being undertaken on the Kusile Power projects, continue driving the collection of all outstanding slow-paying receivables, continue our focus on the reduction of loss-making projects, and returning the group to profitability. This brings us to the end of our presentation. We are now available to respond to any questions that you may have. Thank you.